What is going on, everybody? Bullish Bears Kevin here with another great video for you guys. Today's video is going to be on the SMT trading strategy. That's the smart money trading. It's an ICT strategy. That's the inner circle trading. It's a fantastic way to understand market context and a great way to spot reversals as well if you trade the S&P and the NASDAQ. Let's get into it and I'll break it down for you guys. So, smart money trading, smart money divergence, SMT for short, is an ICT trading strategy based off divergence between the Nasdaq and S&P 500, which I said in the intro. The setups require a divergence, whether it be some type of higher high on the Nasdaq and lower high on the S&P, vice versa, or if we're looking at a bear trend, we'll be looking for the lower lows and higher lows. What we look for with these divergences are shifts in market structure and a reversal in the market. So if we're in an uptrend and we see that the Nasdaq created a lower high while the S&P created a higher high, I'm going to want to short the Nasdaq because it's the weaker of the two and there was divergence. And even though we were going up, I want to trade the reversal because I want to see a lot of buyers trapped in the market, so we reverse strong to the other direction. What is market structure? So market structure is super important to know and understand before trying to even wrap your head around what, an ICT, SMT, what these market structures and divergences are. So basically, market structure represents the framework within which price movements occur in financial markets. It provides the organizational context for understanding how assets are bought and sold, and trend analysis involves recognizing the sequence of higher highs and higher lows for an uptrend, and lower highs and lower lows in a downtrend. Once you're able to understand just those basics, it really gives you an advantage when it comes to trading the stock market. Understanding market structure aids in identifying trends, whether bullish, bearish, or even ranging, right? So if we see that there's a range, we'll know to sit out. When we see that we're both continuously making higher highs and higher lows on NASDAQ and ES, we know to just keep buying the dip. Or if we're creating lower lows and lower highs on both of them, we know to keep selling the rip. So what we're going to see here is we're going to see two charts. The left chart is the S&P 500 and the right chart is the NASDAQ. So this is just a basic, right? We're in a range. However, whenever the ES makes a higher high, the NASDAQ makes a higher high, right? And whenever we make these lower lows on ES, the NASDAQ is also making lower lows. There's no divergence. We're in a trend. We're in a range, but the market is just sort of staying within that range, and ES, NASDAQ, there is no divergence. Now, this is going to be a picture where we see on the 5-minute chart divergence on the NASDAQ and ES, right? NASDAQ, and when I say ES, I am referring to the S&P 500. ES is the futures contract of that. So we see that the NASDAQ created a lower high while the ES created a higher high. So what we would do is we would look to play a short position on the NASDAQ because it created the lower high. Now we know it's weaker because it failed to break that previous high that we had, whereas ES was able to break that previous high. So what we would do is we would enter a nice 2-to-1 risk to reward trade on this when the candle closes. So we could always wait for the candle to close once we're making some type of divergence like this. That way we could be certain that the trade is most likely going to work out and we could really trade with the probabilities. Whereas if you don't wait for the trade to close, the divergence might not occur. And what could be a long wick here on the NASDAQ, this could have been a full body candle and we could have maybe marched up to a new higher high. So waiting for the candle to close is important to really trade more in your favor. However, if we did notice that the ES, S&P was failing the higher high really strong. We saw a lot of selling pressure. Volume stepped up here. Same with the NASDAQ. We saw volume really started to pick up once we started sweeping some stops. So I would say, okay, we could maybe enter around the 15,915 or 15,910 area. Again, a nice 2-to-1, even a 3-to-1 risk to reward on this trade on the NASDAQ. However, if we did break it down to the 1 minute time frame, we'd be able to enter, this is an 8-to-1 risks or reward trade. That would be, you'd be risking 100 to make $800. That would mean if you got two of those, if you got two 8-to-1 trades in a row, right, you were up $1,600 and you kept your R multiple of $100 for every single trade you took, and you lost 14 straight trades. You won 2, lost 14, you would still be profitable. How mind-blowing is that? So once we start finding these higher probability trades as traders, we're really able to not only grow our account comfortably, but really make an impact on our trades and to our bank accounts as well, guys. That's what this is all about. But we got to remember, we got to take it slow. Once we're learning, if you're beginning and you're watching this, you can't be expecting, okay, watch this video, I'm going to go make $1,000 tomorrow. Got to take it slow, got to understand, got to really grasp what's going on. Watch it a couple times, go over market context, and review the charts too, guys. Always important. So, again, like I mentioned before, we had increased volume, right? Increasing volume on the 5-minute. We had increasing volume on the 1 minute before. Where is that? Right, so the increasing volume on the 1 minute too, we trapped a lot of liquidity. Now, something I wanted to mention as well is people who were going short on the NASDAQ on this push lower, they're putting their stops, they're entering short here, entering short over here. They're putting their stops around 15,920, 15,923 at these wicks over here because they're looking at this momentum at this point in time. These candles haven't formed. They're saying, okay, this is just going to keep selling and selling. Now they're going short, they're chasing, they have their stops up here. Now the market bounces back. And what does the market need to move? The market needs volume to move. So what's the market do if it can't find the volume from just enough institutional pressure? It's going to go stop hunt. It's going to go stop out retail traders. It's going to go to an area where it knows it could pick up a lot of volume before giving us the move lower. So think of the people who were short here. They stopped out on this pump thinking this is going green, it's reversing, we're going back higher. What happens? They stop out just for the market to continue in their direction. So, as many of you have heard before in the past, instead of putting our stops where others are putting our stops, we want to put our entry points. So again, stop hunts are important. We have a liquidity grab candle right here. This is on the 1 minute, and we have a long upper wick. That's what forms the liquidity grab, right? And it failed to close above it. That's another nice confirmation, plus strong volume. Again, the volume increased because a lot of people were stopping out of this because of how strong the move was. Candle closed like this. We could have taken this trade. Either when this candle, this 1 minute, broke below this at around 15,920, or we could have even taken it right here around 15,923 with our stop loss just 5 points away. A 5-point stop loss on NASDAQ is a super tight stop loss, and yet we would have been able to nearly top tick this down move right here. That would have netted us about 50 points, guys. 5-point stop, 50-point rule, a 1 to 10 almost. That's crazy. So why is liquidity so important? Liquidity grabs and stop hunts are so important because the market needs volume to move, and for every buyer, there must be a seller. So when everybody starts hitting that stop out button, there's institutions sitting there filling all those orders. They knew exactly what they were doing. They were pushing the market to those stop hunts so that it could finally fill all of the rest of their orders so we could continue back lower. Stop hunts are very common and important in the market and tend to be at recent swing highs or lows. And they also tend to be where you'd believe retail would put their stops, right? Somewhere basic, somewhere a little almost obvious, right? Like if we had, we had in the previous picture, we had the drops on the 5-minute. We had a strong push lower. We sort of ranged from 15,915 to about 15,920. Range there for a second, dropped again, so people would be putting their stops at the top of that. Again, stopping them out, creating the divergence for the confirmation, increased volume, a third confirmation. We got a great trade ahead of us, whether it's a clean scalp or just a really nice move. And again, remember what time frame you're looking at, whether it's the 1 minute, 5 minute, or 15 minute. That's the time frame you want to be trading that liquidity grab on. All right, guys. That is it. Appreciate you all for tuning in. Make sure you hit that like and subscribe button. Join our community, bullishbears.com. Click that join button. We have monthly, yearly, and lifetime subscriptions. Hope to see you all in the rooms. Have a great day and happy trading.